It's Tuesday, November 12th. Welcome to Market Foolery. I'm Chris Hill. Back in studio, Jason Moser. Thanks for being here.
We had so much fun yesterday. We thought, hey, let's do it again, right?
Well, I did mention last week, we've got the annual meeting for the Motley Fool is this Thursday and Friday. So that just means we're recording everything in a shorter amount of time. And so later today, going to be recording Thursday's episode. It's all hands on deck. It's full of palooza. We're excited.
We've been at this for like 10 years, man. Market Foolery, when I'm making that list of priorities out, Chris, let me tell you, you and Market Foolery are right there at the top. Every day.
Don't tell your manager.
Don't you doubt it.
We're going to talk augmented reality. We're going to dip into the Fool mailbag. We're going to start in the automotive world. Third quarter profits and revenue for Advance Auto Parts came in higher than expected. It is the sixth consecutive quarter of new sales growth for Advance Auto Parts. Why is this stock falling 8%? This is a good quarter and continuing a pretty nice trend for them.
Well, okay, you say it was a good quarter. I wrote this down here. I said it wasn't really a bad quarter. And so maybe I'll start with that. It was really, though, I think it was more of the same of what we've seen from this company over the past several quarters. And I think the market is probably reacting. And there's a little bit of a tightened guidance there on the comps numbers, their expectations on comp sales. And whether it's restaurants or auto parts, I mean, when it comes to retail, comps is obviously a metric that matters a lot. And so I think they lowered that high end on the comps guidance by about 50 basis points. The market's probably a little bit concerned about that, along with the fact that there are some challenges that the business continues to witness. Now, let's talk about some of the positive trends first, because their professional side of the business is continuing to show progress. Their e-commerce channels are continuing to show progress, and they're making a lot of investments in their loyalty program, the Speed Perks loyalty program, which is like any retailer. I mean, you're putting together a loyalty program to bring people back, to get more data, to sell them more stuff, give them rewards, and it really creates that nice virtuous cycle and a long-lasting relationship. So that's good. It does seem like, though, the headwinds, the problems or concerns maybe outweigh the good. Transactions were down. There's still some traffic concerns there, no pun intended, store traffic. When you look at the investments they're making in the business, they're trying to stanch this gross margin compression. And when you stretch it out over further periods of time, when you look at it over the last 5 years, you can see they're having some issues there really getting that gross margin stabilized. And that ultimately flows all the way down to the bottom line. Speaking of the bottom line, while they were able to grow earnings per share 11%, net income was only up about 6.5%. And a lot of that really is due to just managing the business, managing the cost side of the business. So they're repurchasing shares. That's helping boost that EPS number. So it's not all really that bad. It's just not that great. And when you look at the competition in the space, I mean, when you compare the 5-year charts, I mean, between Advance Auto Parts, AutoZone, and O'Reilly, I mean, Advance is the clear laggard. And the problem is, over all that time, while O'Reilly and AutoZone have continued to make progress and separate themselves, it's really tough to gain that ground back. It's such a competitive space. And that race down sort of on the pricing side just continues to accelerate. It really is. It's more difficult for them to make up that ground. And so you kind of get to where we are today. Is it a value play or is it a value trap? It's hard to say, but I kind of feel like I'm leaning toward the latter at this point, just based on the numbers that we're seeing today.
You mentioned the loyalty program, and I think it's worth mentioning loyalty programs for national chains. Once upon a time, it just seemed like this nice bonus thing. And now it seems like table stakes that whether you're selling auto parts or coffee or whatever, if you don't have a loyalty program, you almost need to explain yourself. And I have to believe that if you don't have a loyalty program that you are actively trying to grow, then it's reasonable to assume that you've got cash flow problems, because that seems like an investment worth making. Yeah,
and I think another challenge with loyalty programs, and I find myself falling into this trap often, you go to any store and they ask you, are you a loyalty member? Are you a loyalty club member or whatever? And half the time, It's like, no, I'm not. Do you want to sign up? No, I don't. I just want to buy my stuff and get out of here. And so, I mean, a good example, I mean, you know, I like to paint, so I go to the local art store and I get my stuff from time to time. I don't do it that often. I mean, sometimes I buy stuff from there. Sometimes I buy it from somewhere else. But whenever I go to this store, they're like, hey, are you a member of the loyalty club? And I'm like, no, I'm not. I just want to pay for my stuff and get out of here. Is it worth the extra 10% or 20% to me? Typically, it's not. I'm starting to value my time a little bit differently as opposed to when I was 20 years younger. But, you know, that is something where the store, I mean, I'm losing out on that little bit of savings, and that's my choice to make. But the store is really missing out on a lot of data that they could get from me, and they could really start catering to the specific things that I'm buying there. So I feel like retailers, they need to figure something out there. There's a point of friction that they've not fully figured out in many cases. And
some of them have.
Some of them have. And I think, I don't know specifically what that is. Maybe it's the nature of what you're buying. I mean, when you use Starbucks loyalty program, for example, it's pretty easy because you're going there on a daily basis. You know, with the one-off purchases or the more infrequent purchases, it becomes a little bit more difficult to fully figure that out. And so, I mean, I'm not saying I have that solution, but I think that's something that they need to work on. The more they can reduce that friction, the more data they're going to get, the longer the relationship they can create, and the better that works out for everyone.
Snap has launched Spectacles 3, the latest version of its glasses, now with augmented reality. And for just $380, you can buy a pair, record video, apply 3D effects, and then post it to your Snapchat account or other social media networks. Shares of Snap, I should point out, are up a little bit today. Is there reason for optimism for Snap's business based on this latest launch?
Maybe. I would say maybe. I mean, I think if you're looking for an investment in wearable technology, Snap is not it. I mean, this is, I defy you to give me one reason why Snap is a better bet here as opposed to something like Apple or Microsoft or Alphabet, because, I mean, it's not. And if you say it's because they're smaller and more nimble and they can move faster and break things more quickly, I mean, that's not the case there. I mean, that's not an advantage here. That's actually a disadvantage. They don't have the same resources to devote to this kind of stuff. And frankly, I don't think they have the same talent. I mean, when you look at companies like Microsoft and Apple and Alphabet, they are working on that headset and augmented reality and mixed reality. They have more resources. They have more talent. They've been at it for a lot longer. So then you look back to what Snap ultimately is. I mean, it's an ad play, which on its own, that's fine. But I mean, it is a niche social ad play, and that to me makes it far more difficult to get behind as an investment. And you know, contrary to popular belief, I mean, I really do want to like this company. I mean, in its last earnings call, management used the phrase augmented reality 21 times. And I mean, that to me, it's right up my alley in regard to the augmented reality service and the ideas that we're looking for. And founder and CEO Evan Spiegel said, I mean, in 10 years, he believes that consumers will widely adopt augmented reality glasses. And I tend to agree with that. I just don't think it's going to be theirs. And that perhaps is the problem. But I think that really when you look at this particular line of spectacles, these spectacles are geared more towards the creators that are using Snapchat. So I think at the end of the day, this is really an investment in engagement. It's not something that you or I would necessarily buy. I think it's something that's meant for the high dollar creators that are giving Snapchat content on an ongoing basis. And so from that perspective, it's an investment in engagement. And that probably makes sense for them because, again, we get back to that point where it's an ad play. It's a social niche ad play, and they need to create engagement. And this is going to be one way to do that.
And to the point we were discussing earlier regarding money that you can invest when you're a business, you name-checked Microsoft, Apple, Alphabet, companies with really deep pockets. And, you know, we were talking the other day about the Apple Watch, first iteration, not that great. Latest version, much better. Apple has not just the money to devote to improving their existing devices, but they've got the time because they've got the money.
Yeah.
Snap, by their own admission, the first version of this didn't really work out. Presumably, version 3 is significantly better. You would hope so if they're charging nearly $400 a pop for them. But they need this to be something that moves the needle more so than Apple does in a shorter amount of time.
There's absolutely no question. I mean, again, we go back to what is their main source of revenue today. It's advertising, plain and simple. And so for them to figure out a way to diversify that revenue stream, I applaud them for being on that now. And I like the forward-thinking nature. But I mean, when you talk about companies like Apple and Microsoft, and I mean, let's throw Amazon in there, and Alphabet. I mean, these are companies that not only have the resources and the talent, but they've got all the time in the world. They've got the fundamentals working in their favor. These are businesses that are clearly profitable. They make a ton of cash, and that affords them all the time in the world. And right now, Snap is not there. Now, that's just because it's a younger company still getting its feet underneath it. But I mean, when you look at the estimates out there in the analyst community, I mean, GAAP profitability is a really long way out for this company. I mean, GAAP profitability isn't going to happen until 2023. And so, that all just goes back to we've got a company here that's valued on excitement. It's valued on potential. It's not valued on fundamentals at all. And it's got a leader that I don't think has proven himself yet. And he's in full control of this company in the direction in which they go. So, I mean, I think as an investor, if you look at Snap and you think, oh, this is just some massive upside potential social play, I think that's a bit naive. I mean, I think we've seen really the massive upside in social shake out. I think that what you have here is an opportunity for a company to continue growing, develop its own identity, start embracing more technology, help steer us towards this new mixed reality technology space. One day they'll be profitable. They'll have some fundamentals that we can value the company on, and it could continue to grow. And then maybe it makes sense as an investment. But this to me is clearly one where I would rather buy it after I've seen demonstrable success. Not well, I think that they're going to do well down the road, because we've seen a lot of those already, right? I mean, I think we hit Twitter like that on, every quarter. It was the potential, and it just doesn't always work out.
Shares of Snap up 150% this year.
Yeah. I mean, it's been a great year, no doubt. It's coming off an extremely low base in major pessimism. So, I mean, they really had nowhere to go but up. And so, I mean, that to me is a sensible reaction. I mean, it's not been a good investment if you got in at the IPO. Again, I feel like it's one where you're probably it's more sensible to buy this thing once it's proven that it can succeed, that it's sustainable. Doing anything before that is, that's going to be your higher risk holding in your portfolio.
Our email address is marketfoolery@fool.com. Question from Snahanch. Hope I'm pronouncing the name correctly. Sorry about that. I'm new to the investing world. You always say that investors should begin by first investing in index funds. After some research, I bought some shares of a broad market index fund ETF. While continuing my investment in index funds, is it preferable to continue buying more shares of my existing investment, or should I seek other investment funds opportunities as well? Thanks for all your help. Great question. We do say that all the time, that it's such a great first step when you're starting to invest, just get that exposure to the broad market. I am not one of those people who invests in multiple index funds, although there are people who do very well just looking at, once they start with a broad market fund, then they say, you know what, I'm going to focus on a small cap ETF or a small cap index.
Yeah, I mean, a lot of people are really only invested in funds, right? I mean, if you look at it from the perspective of, just investing in your 401k or whatever your retirement vehicle may be. I mean, in most cases, you're choosing from funds in how you allocate your money. And so from that perspective, I mean, the short answer is yes, you can absolutely invest in more than one fund. You can reinvest in the fund that you own already. I mean, people can be very successful just investing in ETFs. And I think that really that kind of gets to the greater point here of making sure that you understand what the ETF that you're invested in represents. And so, when we consider this email, for example, and the fund in which he's invested, it's the Schwab broader market fund. The ticker, I think, was SCHB. So, I did a little research into that particular fund to get a better idea of, what does this fund actually represent? I mean, this is a really big fund here. I mean, this is a fund that holds essentially 2,500 U.S. stocks. And for context, and we talk a lot about the S&P 500, I mean, the S&P 500 is, surprise, 500. So this particular fund owns a really big basket of stocks. And so then you have to ask yourself, if you want to invest in another fund, you probably want to invest in that other fund to get exposure to something that you don't have exposure to already. Otherwise, maybe it just makes more sense to add to the fund that you already own. I mean, this fund itself is highly rated by Morningstar. It's reputable. It's Schwab. So, costs are low. Turnover is low. There are low frictional costs involved with it. It's a market cap weighted fund. So it skews towards the bigger companies. And, one argument for that could be that, hey, well, the bigger companies keep on winning and they keep on getting bigger, and you want to own those companies. So generally speaking, yes, you can own as many index funds as you want, or ETFs. You want to just understand what is in the ETFs that you currently own, and then try to figure out, do I need to buy something else to get exposure to something else that I don't currently own? In this case with SCHB, I mean, this is a fund that owns a lot. In most of those companies are probably represented by other funds that you would have access to anyway. So maybe in this case, you don't need to own another index fund. Maybe this is all you really need from that perspective, and you can just keep on adding to it. I mean, I own one index fund. It's the S&P 500, and I just keep adding to that every time I get paid here at work. I don't feel the need to go any further than that because I've also got individual stocks and I've got some real estate and other ways to diversify my portfolio. So hopefully that sheds a little bit of light on it. It really boils down to just understanding what's in that fund that you own. A lot of different ways you can find that out. If you just, go to your trusty Google and just type in the name of the fund, typically that'll bring you either to the page of, that'll bring you to the homepage of the company that sponsors the fund, or it would take you to something like a Fool site or a Morningstar site or something where you can find the components of the fund. But just understanding what is in the funds, that can help dictate where you put your future investment dollars.
Real quick before we wrap up, because we talk about entertainment pretty frequently on this show, and it came across in my Twitter feed a lot of entertainers tweeting about Rick Ludwin, who was a executive at NBC, died the other day at the age of 71. And I'll put this out on the Market Foolery Twitter feed, a very nice obituary. But all of these tributes about this sounds like for someone who's spent his life in the television industry as an executive, a pretty soft-spoken guy, a pretty mild-mannered guy, and a lot of wonderful tributes being paid to him. But from a business standpoint, Rick Ludwin is the lone executive in NBC who believed in a show that was originally called The Seinfeld Chronicles.
He was that one guy.
He was that one. There are all these other executives who are like, I don't know about this show. It seems like it's too New York. I don't think it's going to play well, that sort of thing. And Rick Ludwin believed in the show so much that he had money in a budget. They did, like one episode, showed it to executives. They're like, I don't think so. They all turned it down. And he had money in a budget that was for specials. So just like, hey, we're going to do a concert special or, any kind of primetime special that he wanted to do. He had money set aside in that budget. He took all of that money for 4 primetime specials and said, I want 4 episodes.
Oh, wow.
I'm going to get 4 episodes of the Seinfeld Chronicles, going to put it on TV. And that got the whole thing started.
That's an amazing story.
Yeah.
When you think about, you talk about shows that have changed the world. I think Seinfeld is certainly one of those shows. That's one of those shows that continues to, I think, hold true in a lot of ways today. It is developed obviously a rabid fan base, and frankly, I think social media has only fueled that fire. You see, that only happens every once in a while. We talk a lot about data, Netflix, Disney, all these companies using data to make decisions and whatnot. At the end of the day, these shows are art. And art is not so easily figured out. Right. That's why they're special. Right.
And people decide ultimately, it's like you can, we were talking right before we started recording about reviews. And some people rely very heavily on movie reviews, television reviews. Ultimately, it's the people who just decide what they want to watch.
Precisely.
Thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show's mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.